Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and this week is going to be a big week. This week we got CPI coming up, and CPI is something I still maintain the majority of market participants have gotten wrong. I still think it's only reasonable to expect continuation of disinflation. That is to say, further CPI prints that come in below the prior readouts. We are still rocking with the base case hypothesis on this channel, and that is that we are on our way to a blow-off top, whereby the rate cuts mark the top, or at least close to the top, for the stock market. For Bitcoin, we are still expecting this left translation to occur, and I know a lot of people are not happy with this idea at the moment, but we're going to get to the charts at the end, as always. The focus for this week alone, I think, needs to be on whether or not we do indeed see the continuation of disinflation. So I've been making the case anything you do to the M2 rate of change shows up in the CPI with around an 18-month lag. We saw this violent snapback in the rate of change and a wobble, which coincided with this and the market believing that we had a sticky inflation narrative. Over the last print or two, we have started to see what I believe is the third and final leg down in the M2 rate of change start to manifest in the CPI print. And of course, we've got another leading indicator here, the TMC Global Credit Impulse, which tells us to expect continuation of disinflation before ultimately a short period of asset price deflation. So whilst the whole market is sitting here saying inflation's going to be sticky, and that may well be the case this week, okay, we're going to find out. But I've been making the case over and over again that we're probably going to see CPI continue to come off. I find it interesting that this could well be a major catalyst to see markets and Bitcoin find their lows this week, rally massively off of a surprise cold inflation print and the expectation that we'll see rate cuts sooner than most people are ready for. When we take a look at this chart right here, this is the CPI, doesn't it look an awful lot like we've got that down sideways wobble followed by a resumption down? This current chart does not include the most recent print, which would put us somewhere in this neighborhood. And again, I am here to say, if this week we see the CPI print coming colder, it will have all the familiar symptoms and characteristics of this third and final leg down that is expected to present in the CPI data. So another big week, okay? Of course, if we see sticky print or a hot print, then I have to hold my hands up and say this is not what's in play. But if we do indeed see CPI continue to come off, then again, I'm here to say we are probably going to see the third and final angle set across all risk assets. The stock market indeed is going to continue to melt up. And this is largely because the markets will want to front run the incoming rate cuts. We know that if we exclude shelter from the CPI basket, which is the biggest lagging component, we're actually deflationary month over month already. So these are not popular ideas. Okay, but that is honestly how I like them the most. Meanwhile, when we pull up the CPI, okay, more than 50% of the 74 US CPI components are currently running below 2%. So the basket is already well under control, well below where the Fed wants it. And as I keep saying over and over again, I expect this week's CPI print to come in even colder, catch most of the market off guard. And like I said, I expect that to lead to a parabolic blow off top, a continuation of the melt up in the stock market. And I would even speculate, and I know a lot of people are going to be really upset about this, but I would even speculate we're probably going to see Bitcoin stage some kind of large upside push as well. Meanwhile, we keep seeing the labor market deteriorate, okay? We continue to see this increase in continuing jobless claims is notable, okay? That is not nothing at the hard right edge. It continues to get worse here because they just keep doing this thing where they revise the data down quietly a little after they release the initial print. So the May jobs has been revised from 272k down to 218k, and April revised from 165 to 108. Okay, so the question becomes, why do they keep lying about the data? And I've been making the case that they don't want to signal to the market that they are going to be forced to cut rates sooner rather than later. Again, similarly to how the market is wrong-footed, in my humble opinion, by expecting sticky inflation, I also have been making the case that they are wrong-footed by expecting a higher for longer rhetoric and not seeing any cuts until towards the end of the year at the earliest. But given how they keep revising these jobs quietly down a couple of weeks after the initial print, given that unemployment has now risen to 4.1% when their target for the end of this year was 4%, for unemployment, I think alarm bells should be ringing here, and that all we'll need to see is that colder CPI print to suddenly see a huge repricing and even the Fed start to come out and be a little bit more dovish pertaining to rate cuts. Not to mention, the economy is slowing. A recession seems to be coming, and everyone is kind of distracted by looking at the stock market keep melting up. Yet under the hood, okay, the economy is slowing. Again, it's another point in the favour of seeing these cuts ahead of what most market participants expect. And thus, I've been making the case again that we are possibly going to see these cuts show up a lot sooner than most people are anticipating. Pause your screen and take a good look at this and think about the implications. Meanwhile, I continue to sit here and say the 2-year yield is the signal. Okay, whenever we see the 2-year yield for the US move lower, we see the onset of a cutting cycle shortly thereafter. We've seen this in every other one of these cases. And I've been saying that unless we get an invalidation and the 2-year yield start to move higher, then everyone that is sitting here and saying higher for longer, no way they're going to cut in the next couple of months, to that I simply say once again, tell that to the bond market. When we look at the bond market, okay, this is the 10-year yield. Everyone was getting spooked in the week by this push higher, but as you can see, so far, it's another lower high relative to this high, it's another rejection at resistance, and it now looks to be wanting to continue to move to the downside, particularly if we see CPI come in below expectation, then this is going to continue to move down. When we look at the 2-year yield, what do you see at the hard right edge? Okay, what do you see? Because I see the resumption and new lows for the US 2-year yield. Meaning, when we come back to this chart, we are very, very rapidly morphing in to one of these looks. And again, I am here to say, okay, tell that to the bond market. The central banks, remember, always know stuff ahead of time. They always know more than the market participants do. And the reason they price this yield lower, okay, is because they understand that rate cuts are coming sooner than the Fed would have everyone believe, sooner than the market is anticipating. If we do continue to see further downside, okay, then based on historical data, there is no other way to interpret this other than surprise cuts are coming. And I would say, again, particularly if the inflation comes in cold this week, and we get some kind of Fed speak with dovish overtones, I suggest to you that this is going to continue to move lower, implicating rate cuts are coming sooner than most people expect. And the important part about all of this is risk assets, and I would speculate Bitcoin as well, tend to front run the onset of this cutting cycle. Whilst Bitcoin is to be determined as whether or not it's going to actually take part in this final leg to the upside, the stock market has already proven itself, okay? The stock market continues to front run these incoming rate cuts. And if we do see these cuts show up in the next couple of months, okay, historically speaking, that tells us that the end is nigh for the risk asset rally and that a bear market and recession is soon to be showing up. Again, we see this here, the onset of a cutting cycle, markets top, onset of a cutting cycle, markets top. The question is, will this time be different? I don't think so. And the reason I say that is because cuts into normalization can be bullish and result in further upside for the stock market. But what we're about to see is not cuts into normalization. We're about to see cuts because something has broken. Unemployment continues to spike. The labor market continues to deteriorate. Inflation is nowhere near as sticky as everyone thinks it is. And the economy continues to slow towards what I believe will be a quite nasty and severe recession. All of this, of course, against the backdrop of the US 2-year yield, as I said, calling the Fed bluff, okay? Again, I am here to say, if you think rate cuts are not coming anytime soon, well, tell that to the bond market. The central banks that always have the insider information are already pricing this in. And unless this thing changes, unless this violently reverses and breaks out, giving us a change in market structure, then once again, I am here to say, tell that to the bond market. Rate cuts are coming sooner than most people are ready for. Keep in mind, all of this is occurring against a parabolic blow off top and a fully established third angle for the stock market. The Nasdaq looks even more parabolic, as you can see here. Okay, setting its third angle, continuing to mercilessly melt to the upside. I think the Dow Jones is going to be working on putting in its third angle in the not too distant future. And I've even been speculating that unlike normal bull runs, where we see breadth narrow towards tops, I believe this time is going to be different because we are at the end of the multi-year cycles, the multi-decade cycles, and thus we're even going to see breadth widen as, again, the market realizes it is wrong-footed. It is expecting sticky inflation, it's expecting no cuts anytime soon, and it's going to be forced to realize once we see this colder CPI print this week that actually everyone has been completely wrong-footed. It's time to have this blow-off top ahead of those rate cuts, which, as I showed you before, are likely coming in the not-too-distant future according to the bond market, which is synonymous with seeing the top come in within a couple of months of the onset of the cutting cycle. The only missing component here is for Bitcoin to actually move into its third and final angle. And I know there's a sea of bearishness around Bitcoin at the moment. I know a lot of people don't believe that Bitcoin could find a cycle low any day now, recover this trend line, and then move into its third and final angle. But for me, the backdrop is absolutely pristine to see me get long here in the not too distant future. In amongst a sea of bearishness, in amongst a sea of people saying that that was the top, and what comes next now is a multi-year bear market, even though those people were not even entertaining a multi-year bear market up until the last couple of weeks. We've got a sea of people calling for 30k, a sea of people thinking that the stock market has blown off, so why hasn't this thing followed? And I am here to suggest to you that we might have just forced a weekly cycle low. We might be about to catalyze a recovery of the second angle this week on a lower CPI print, and the market will do what it always does, which is front run the onset of that cutting cycle. Thus, I do not rule out the opportunity for Bitcoin to get one final squeeze to the upside. And if you are doubting this, then I simply say that is fine. You are welcome to doubt. You are welcome to be short now. I honestly think all it will take is a lower CPI print and a bit of dovish speak from the Fed, and we will probably see Bitcoin do Bitcoin things once more. We may also see the Dixie soften slightly on the news of softer inflation and perhaps incoming rate cuts. So, of course, if the Dixie can move lower, that would also provide fuel to see Bitcoin, the precious metals, and the stock market continue their moves higher. So once again, I'm here to tell you, it is a wild time to be alive. Nothing has really changed significantly. The unemployment continues to worsen, as I showed you. The inflation continues to be perceived as sticky. We're going to find out if that's true this week. Rate cuts apparently are not coming anytime soon, unless you consult the bond market, which is actually signaling they're coming a lot sooner than people think. And all of this against the backdrop of a rip-roaring near-vertical stock market. This week is going to be huge. It's likely going to be a massive catalyst. And I would speculate once more that the Bitcoin bears are about to pay the true price for being bearish on Bitcoin so early in its cycle. As ever, I continue to take this thing one day at a time, continue to check in on it, continue to monitor it. I'm probably going to go live again for CPI because that was really fun last time. Other than that, if you're a level 3 member, look out for the members only video that's coming in a minute. For everyone else, I hope you're doing well in life. Have a great weekend. Until next time, take care. All the best. Cheers. Bye.